Good afternoon, everyone. Good morning as well. Thank you so much for joining us in this special edition talking about captive insurance and self-insurance in Labuan IBFC. We're very excited today because we have close to 300 of you registered for this, and the interest has been far and wide. Really, the insurance industry, risk management, reinsurance industry in Labuan has grown from strength to strength. We're now home to more than 220 license holders, and we are the fastest growing domicile for self-insurance in Asia. Really, it's been an interesting journey for us in self-insurance and reinsurance, really because we are known as a Malaysian domicile first and foremost. But over the last 7 years, what has happened is that we've really grown into a reinsurance, regional reinsurance center. At the moment, especially for captives and self-insurance, more than 60% of all the premiums are no longer Malaysian. So it's an interesting development for Labuan, and we're very excited because it's really a possibility for Labuan to grow this space even further. We are, as you know, the only jurisdiction in Asia with a protected cell company structure for self-insurance. And this has created a lot of interest in this area, especially as the markets have gotten quite a lot harder. Even pre-COVID and now during COVID, the markets have gotten harder. And because cells provide a very quick and efficient way of getting coverage getting coverage for your risk. So we're very excited about this area, as I said earlier, and it's really exciting to see our intermediary like Park Lane take the initiative to join us today to talk a little bit further about the benefits of self-insurance. I'd really like to also thank, so we thank Park Lane obviously, but we also like to thank Kajak from the Rating Agency of Malaysia for sharing a little bit of his insights soon with regards to the risk profile of the region, and to our panelists, our dear panelists who will join me later in our panel session. I hope you will join us there and maybe share some of your questions, any questions you may have for the panel. To our media partners, Asia Insurance Review and Middle East Insurance Review, to the risk managers associations across the region, and also to Parima, thank you so much for your support in sharing information about this conference to all your members. We really hope you find this webinar useful. And please let us know what you think via the feedback form, which will be available at the end of the session. So thank you for spending a couple of your hours with us today. And now what I'd like to do is invite Kajak to share his screen and talk us through the Asian and MENA risk landscape and outlook. Kajak, over to you, please. And thank you.
Thank you, Farah. So first off, just good afternoon to everyone. And first off, I'd like to just thank the organizers for inviting me to speak at today's webinar. There's always been saying about economists like myself being worrying too much, but I think to them I like to say maybe they are worrying too little. So in a way, I'm a bit glad that there's this forum today that will just briefly let me highlight some of the potential upcoming risks that may actually affect growth in your business or maybe in your current sector, given the current economic predicament at the moment. So before I begin, maybe let me briefly just lay down what I'll be presenting today. So I'll just first start off with the general economic outlook this year, and then I'll just cover some of the four main thematic risks that I've identified, as you can see on the slide at the moment. And then lastly, I'll just round off the presentation with some key takeaways. So first off, the global economic outlook. So the world has definitely been thrown into disarray since the global pandemic began last year. So this also plunged the world into its first global recession since the global financial crisis. So nonetheless, we can fairly certainly say that we have reached a trough in 2020, and referencing both the IMF as well as the World Bank, the global economic rebound in 2021 is fairly certain. And the two international organizations have also announced multiple GDP growth forecast upgrade this year. So as of their last update, we can see that the IMF actually upped the global GDP growth forecast to 6%, while the World Bank has also raised theirs to 5.6%. So both indicating a relatively healthy economic prospects. moving ahead. But however, once again, putting on my risk-averse hat, you can say that 2021 will remain a very challenging year with many uncertainties as well as risks moving ahead. So as also aptly captured by their reports, as you can see on the slide, the recovery will definitely be fairly uneven and will not be shared across the world, with much of the developed markets such as the US as well as Europe enjoying much of the benefits that come from the reopening of the economy, while emerging markets like say Asia as well as MENA will likely continue to struggle with the economic fallout of the pandemic. So the key buzzword I think I'm going at the moment is that you'll be hearing a lot of the word, me saying a lot of the word uneven throughout the presentation. So pardon me if it feels a bit repetitive, but I think it's a very important point to actually drive home for today. So looking at just the growth prospects of economies in Asia as well as MENA, most countries are actually expected to rebound from its trough in 2020. But however, once again, the recovery is actually expected to be relatively uneven. So in Asia, you can see that India and China is actually expected to lead the recovery, while some of the other countries are actually expected to go below the global growth for 2021. While in MENA, Israel and as well as Morocco is expected to lead the recovery for the region. But with that, this brings me actually to the first risk that I would like to highlight, which is that any of the projected rebound of the economy at the moment is not actually a given, given how we see that there's actually high infectivity of the virus that we see throughout the region. So we have seen numerous resurgences of COVID-19 infections around the world over its very brief history. So with each wave also being even higher than the next wave. So furthermore, the emergence of the highly infectious Delta variant that we see recently has also aggravated the health crisis, especially among the countries in Asia as well as the Pacific, as you can see on your right-hand side chart. So notably, we noticed that countries like South Korea, Vietnam, and Taiwan, which has actually done relatively well in containing the spread in the past, actually recently succumbed to the virus. As you can see, this actually led to soaring cases as well as significant tightening in terms of restrictions. So as you can see from the left-hand side chart, looking at the latest trend in terms of COVID-19 cases, it seems to suggest that we are actually on track to see another huge wave of infections in the near term. And this has actually some potential to derail the nascent economic recovery that we saw at the start of this year. So one of the best way to actually mitigate the risk to the economic recovery that is actually posed by the pandemic is actually just to vaccinate. So what we can take a page out of the advanced economy at the moment is that we can see that they actually have a relatively rapid pace of vaccination. So as such, they are the first one that could actually afford to open up the economy and actually return to a more normal life. As you can see on the right-hand chart, where mobility restrictions have actually loosened quite significantly over the past 6 months for the more developed markets. So this actually gives us hope that maybe countries in Asia as well as MENA can actually also return to normal soon. But however, as you can see on the left-hand side chart, vaccination rate in Asia and MENA actually is still very much lagging behind. And this is also why the latest wave of COVID cases have also been primarily concentrated in these two regions, as I've also presented in the previous slide. So unless there's actually that massive ramp up in vaccination rate, recovery risk for this region remains actually very elevated. If we drill down to the individual countries within the region, the risk of a recurring lockdown and potential derailment in terms of economic recovery also differs across countries. So this is given that once again, there's actually the unevenness in terms of vaccination rollout even within the region. So in Asia, the recovery risk is actually fairly high for countries like some of the South Asian countries like Bangladesh, Pakistan, as well as Philippines, as well as Vietnam, given the low vaccination rate coverage. So if on your right-hand side chart for MENA, the overall vaccination rate on average is generally higher than Asia, so their risk is likely slightly lower, but there's still some obvious outliers such as Iran as well as Egypt, which has a very fairly or relatively low vaccination rate. So maybe among countries that have low vaccination rate, you likely also need to incorporate the likelihood or high likelihood of frequent reopening and closing of economy into some of the risk assessments and risk mitigation process at the moment. So next, while vaccination will mainly help mitigate the risk during the pandemic, I think another key thing to also look out for is what about the economies post-pandemic? So what sort of downside economic risk could we face post-pandemic? So one of the prominent risks that is being debated at the moment is the risk of economic scarring, where economy could actually see some form of permanent loss of economic potential due to prolonged lockdown pressures as well as persistent underinvestments towards the economy. So some of the countries have actually tried to actually roll out support measures to mitigate such risks, but then again, the level of effort is also vastly uneven across country. As the chart, as you can see, currently actually plots the level of lockdown measures implemented to the economy across countries against the level of policy support as well towards the countries in Asia as well, MENA. So ideally, the larger the lockdown impact, the more policy support that's actually needed. However, we do note that there are actually a few relative underperformers, as circled by the dotted red circle, as you can see in the chart. These countries actually face significant stress, but actually does not actually receive the corresponding level of policy support from the government. So this might actually risk setting them behind in terms of future potential growth moving ahead. Next, if we move away from the economy and maybe look towards the financial market, one of the key trends or the key thing to actually look out for looking ahead is also the unwinding of the QE measure. So one thing to note is that the injection of liquidity by the US Fed due to the pandemic is actually almost 3 times larger compared to what we had during the global financial crisis. So the massive liquidity and the flow of hot money have actually led to a massive surge in capital inflows as well as volatility in some of the markets at the onset of the pandemic. So however, I guess one could say actually the party will have to stop one day, and we could potentially actually see another round of volatility once the QE measures tapers and maybe subsequently also unwinds itself over the longer period of time. So this is definitely an event that we might actually need to pay quite close attention to, and maybe to be prepared and positioned for such unwinding to actually take place. The third risk that I'd like to touch on is just more on the socio-economic side of things, where what are the risks looking ahead in terms of post-pandemic situation. So while the economy comes roaring back in 2021 and beyond, a large part of the benefit is actually still accrued to capital owners rather than the household as well as your everyday person on the ground. So the unemployment as well as wage conditions is likely actually to remain under pressure in the near to medium term, as it actually still lags behind your economic recovery. So if you look at the recent estimate by the International Labour Organization, as you can see on the left-hand side chart, it shows that while employment conditions is actually expected to improve, it actually remain way below the pre-pandemic levels that was recorded in 2019. So, and globally, we are also still expected to see a loss of about 90 million full-time jobs in 2021 relative to 2019's level. So there's still quite a substantial gap or spare capacity that we are still experiencing even this year. So this would actually suggest a continued underperformance in terms of consumer purchasing power or in terms of disposable income, at least in 2021. But I think nonetheless, a slight silver lining is that countries around the world is also noted that labor market is a very key component of the economy to support, and it has actually received quite a substantial policy support by the government. But whether is it sufficient, I think it's too early to call. It remains to be seen at the moment. Another impact from the pandemic is actually the widening of income gap. So one aspect of society that the pandemic has exposed is the social disparity between the wealthy and the poor, or you can say those between the high skill and low skill job, or the type of occupation that can actually work from home, or those that cannot engage in any work-based employment. So as most of the lower income and low skill jobs are typically more front-facing in nature and could not be typically done under a work from home setting, much of the income cuts as well as the loss of employment were mainly driven by this particular group. This disparity could actually mean a further widening in terms of income gap across within society across all the countries in the world. But one thing I think to also point out is notably the scale of widening is actually estimated to be the largest among the developed countries. because based on the recent study by World Bank, high-income nations are actually expected to see the biggest increase in Gini coefficient. So the Gini coefficient actually measures the income equality. So the higher the income, the more the loss of earning that a particular country might see, and the wider the Gini coefficient might actually experience due to this particular loss of income, purely based because of this loss of earning because of being unable to work from home. So such disparity in terms of financial stability and income gap is actually certainly quite worrying, and it is that because it's actually not a very easy or a very socio-economic issue that can actually be resolved over a very short period of time. So as much as we can try, I think this is definitely something we need to prevent from happening. Besides that, the labor market, the education is also one aspect that's actually also quite challenged during the pandemic, as schools have closed to actually prevent the spread of the virus. So however, advanced economies has, with better internet infrastructure as well as technological infrastructure, also were able to move their classes online, but the same cannot be said for the developing worlds which might not have such benefits. So the disruption in educational progress could actually mean long-term loss in terms of human capital accumulation, but it could be too early to make a conclusion at this point in time, but I think it's definitely something to actually pay attention to also moving ahead. Lastly, just a quick one on geopolitical risk. So I think the key downside risk actually prior to the pandemic has always been the US-China trade tension, which has actually resulted in the treaty for that, or the full-on quote-unquote trade war between the two countries, which has also affected the key supply chains around Asia, Malaysia included as well. So at the moment, I think because of the pandemic, there appears to be a ceasefire, quote-unquote ceasefire, as both countries actually focuses on the more common enemy, which is COVID. However, once global economy actually returns to normal, I think both countries might actually start to compete again. And I think we've also seen some spices between the interaction between the two countries, when I think they started maybe calling names or accusing each other of doing something, which I think is also some early signs that tension might rise again once I think the pandemic actually retreats. So I think one of the easiest trigger point in my view for this US-China relation is that the US-China actually, the US-China phase one trade deal is a very long name. US-China phase one trade deal was actually signed during President Trump's era, where I think the trade deal actually is such that China actually agrees to actually increases its purchase of US goods. But actually, I think sometimes we forget this phase one trade deal is actually still an ongoing deal. And I think based on the tracker or what the market has been tracking so far, China is still actually a far cry away from meeting its commitment to fulfill under the current phase one trade deal. So should China be unable to meet the thresholds prescribed in the deal, would this actually trigger a revival of the trade war? I think at the moment, the chances are definitely lower or smaller under the leadership of President Trump. But I think the current administration has also shown its continued reservation or its quote-unquote hostility towards China, and will likely remain very firm on standing with China. So if they wanted to, they could use it as an excuse to maybe engage in another trade deal or further negotiation. But I think at the moment, it's definitely something to actually look out for. And I think lastly, I'll just round out with some key takeaways. So I think definitely what we can definitely say is that global economy is expected to recover in 2021. But then again, downside risk remains, and recovery is expected to remain uneven, especially given the resurgence in COVID-19 cases, as well as the unevenness in terms of vaccination rollout as well. And some of the socio-economic disparity exposed will be actually might pose some downside risk over the longer term. And again, I think US-China will likely be the key theme post COVID-19 pandemic, and maybe it's also something that we also need to pay attention to when that actually happens. And I think with that last point concludes my presentation for today. So back to you. Thank you.
Thanks, Kajat. That was very interesting. I mean, obviously, there's a lot of risks floating around out there, but there's always an opportunity for us to look at it from a silver lining point of view. And actually, you know, just before we let you go and I bring on Annie, there was a question earlier from Leonard Ariokam. Sorry if I'm pronouncing your name wrongly. How about Vietnam, he says, Kajak? It was reported as the only country in Southeast Asia with a positive GDP growth. What are your thoughts about the outlook for Vietnam? And then, you know, I mean, obviously they've had quite a bad COVID situation there as well recently.
Yeah, I think certainly for Vietnam, a large part of the reason why they were able to chart a positive growth last year was purely because of their success in terms of containing the virus in 2020. But I think the same could not be said for 2021. As they have, like you mentioned, recently saw a huge wave of resurgences in terms of COVID-19 cases and some strict clamp-down in terms of economic and social activity once those outbreaks actually persist. So I think definitely in terms of downside risk towards the economy, Vietnam is actually not looking as rosy as last year, I think, yeah.
Yes, and hopefully after this COVID is over and we'll, at least when we get it in control, we'll all just take a bit of rest, you know, and let it all settle for a bit. I think we all deserve it. Anyway, thank you so much, Kajak. Thank you so much for sharing with us. And next we have a presentation on turnkey self-insurance solutions via cell captives. I'd like to introduce Annie. So Annie Undika is the founder and director of Park Lane. She's also the managing director, if I'm not mistaken, of Brighton. Brighton is one of our insurance managers in Labuan, a very well-regarded insurance manager in Labuan. And we're happy to have her with us here today as our partner in this special presentation and webinar on protected cell companies. Annie, can I please invite you to start your presentation? Thank you.
Thank you, Farah. All right. Okay. So I'm happy to be here, and good afternoon and good morning to everyone here. I'm so happy to see that we have over 300 people attending this webinar. For my presentation today, I'll just cover, I'll just go on what is captive and all the different structures that is available in Labuan, and why is there an interest in captive recently. Then I'll go on how do you establish a PCC, a protected cell company, and a cell in Labuan IBFC, and typical structures of a protected cell company. Then I'll go and discuss three different scenarios of how you use a PCC in Labuan, and a brief overview of Parkland Limited, the benefit of having a cell within Parkland, a requirement of Labuan FSA to set up a cell and a pure captive in Labuan. Finally, a cost comparison between pure captive and cell. So what is captive? Essentially a wholly owned insurance company that insure the assets, liabilities, and other risks of its parent company. Simply put, it's your own insurance company. Usually, a captive is located in jurisdictions where requirements such as solvency margin, reporting, taxation are less onerous. I put the tax last because now that is not one of the main requirements. It is also viewed as a form of formalized self-insurance. Self-insurance is actually where a company opts to retain some of its potential financial risks instead of transferring those risks to third party like insurance company. So the different structures of captive in Labuan IBFC. The captive in Labuan IBFC is actually governed by the Labuan Financial Services and Security Act 2010 for conventional captive, and the Labuan Islamic Financial Services and Security Act 2010 for Islamic captive. In Labuan, you may establish pure captive, which is a single parent captive, association captive, where the owner is an association and the captive insure its members' risk, multi-owner captive, where the owner is where it's owned by many companies, and the captive may write risks from all the owners. And we also have rent-a-captive facilities in Labuan. There's 3 types of rent-a-captive in Labuan. One is the normal rent-a-captive, where the assets and liability of the business owner who rent the facilities from the rental are mixed together and maybe ring-fenced through agreement. So there's no legal protection here. We have a master rent-a-captive structures in Labuan. This was done prior to the protected sale company being introduced in Labuan. So each business owner will have to, a subsidiary will be created so that they can ring fence the risk from each owner. And each subsidiary is actually licensed by Labuan FSA. The protected sale company, which come into effect in 2010, it's a legal structure. The assets and liabilities is ring-fenced and governed by the Act. The sale will subscribe to a class of shares of the PCC, of the protected sale company, which is the core. For rent-a-captive facilities, I mean, if you're renting a captive facilities in Labuan IBFC via any of the 3 structures available, all regulatory, compliance, administrative, and financial will actually be handled by the rental, be it by the rent-a-captive company or by the protected sale or the master rent-a-captive. However, for master captive structure, each subsidiary, since it's a company on its own, will need to comply with the economic substance requirement of 2 full-time employees and a minimum spending of ringgit 100,000 in Labuan. So I must say here, Labuan is the first, as mentioned by Farah, Labuan is the first jurisdiction in Asia to have a PCC. Since late 2018, there has been an increase in interest on captive globally, including Labuan IBFC. And this was reported in MASH Global Insurance Market Index as well. The main reason is hard market. It's an increase in insurance rates, meaning insurance has become more expensive. And according to the MASH Market Index, the price has jumped by 22% in 2020, last quarter of 2020. There's a reduced capacity where insurance company can only write up to a certain level of risk, which leave a large amount of risk cannot be insured by an insurance company. So the business owner will have to self-insure this risk. Or they may be able to insure it, but at exorbitant price, which will make it uneconomical for the company to insure with a third party. Thirdly, the reason why there's a big interest in captive now is the unavailability of cover. Insurance company has become selective on risk during this hard market. Certain risks cannot be insured and the company will have to self-insure them. Hence why now a lot of companies are looking at captive to formalize their self-insurance and for their risk management strategy. In Labuan IBFC, the number of captive has also increased. In 2020, there were 10 new captive, bringing the number to 53. The 10 new captives are 3 pure captive, 2 master rent-a-captive, and 5 PCC was licensed in 2010. By June 2021, 5 new captive were licensed, bringing the number to 58 in Labuan. Please note that the number that I mentioned here does not include cells created within the PCC. There are a lot more cells that was created in 2020 and 2021. How do you establish a PCC in Labuan? First, once you decide to have a PCC in Labuan, you select a service provider, and please come to Brighton for that. We will provide you the services. We will help you with the applications and work you through all the different requirements by Labuan FSA. We submit the application to Labuan FSA, and Labuan FSA charter is 30 working days from the date we submitted the application, full documentation. And once we receive the approval from Labuan FSA, approval in principle, we then incorporate the company, and then we will have to open the bank account. We have to do all the different necessary documentation, submit all the documents as required by Labuan FSA in their letter of principle of approval in principles. And then Labuan FSA will issue a captive license to the PCC, and you can commence business. For sale, it's very, very simple. Effective July 2021, I'm happy to say. Approval from Labuan FSA is no longer required for the creation of cell in a PCC structure. So first, what we need to do is discuss the cell formation with the core. Please come to Parkland for that. Parkland is a PCC licensed in Labuan. Then we will execute agreement and resolution between the cell owner and the core, the PCC, and the cell will be created. Once the cell is created, you can commence your business. Within 14 days, Parkland will have to submit or notify Labuan FSA that this cell has been created. So the onus is on the core to ensure that the captive structure is within the captive definition of Labuan FSA, of the Labuan Financial Services Security Act. This will be a typical structure for a PCC, right? It's basically exactly like a pure captive. It's the same. So the cell owner will insure to the cell either through a fronting company or directly, depending where the risk comes from and whether that country require admitted insurer or not. As you all know, insurance is a highly regulated industry. So some country require you to buy your insurance from an insurer licensed in that jurisdiction. So you can go through, you can do, the cell will now reinsure the cell owner through a fronting insurer or directly. And if the cell or the cell owner want to, they can reinsure it out, some of the risk or all of the risk. Yeah. Similarly, claims is the same way, just backward. From a reinsurer goes to the cell, either through the fronting company, then to the cell owner, or directly to the cell owner, depending whether it's a reinsurance risk or a direct risk. So the share participation and cell management agreement for you to set up a cell is basically based on, you calculate the protected cell experience account, calculation of the cell shareholders funds and rights to dividends, investment management of cell fund, maintenance of solvency margin has to be reported to Labuan FSA. The cell profit is derived from, as you can see here from the diagram, exactly like a pure captive. commission, earned premium, investment income. And the expenses will be normally management expenses, reinsurance premium, if any, if you are reinsuring it, and the expected losses. That will be the profit of the cell. And the cell can actually directly pay dividend to the cell owner. Okay, this is I'm giving you three scenarios, three case view of using a PCC. In the first case, the PCC owner has many business or subsidiaries, which are managed by different management team and a profit center on its own. So basically they want their own profit center. They want to manage their own risks. So the cell, one cell will be established for each division or each subsidiary of the business. And the result of the cell will be consolidated by the said business segment or cell owner. So this is the first scenario, first case. And the second, in this scenario, the PCC owner has business in different locations where insurance rates and law may differ. So each cell will be for different location, and each location has its own cell. However, you must note that in case 1 and 2, the core may be able to negotiate for more favorable reinsurance rates for the risk of the cell combined due to higher volumes. This is my favorite. I'm talking about Parkland here. And this is case 3 is basically referred to as commercial protected cell company. The owner of the core and the cell are not related. i.e., the core is renting the captive facilities to any business owners as long as the structure and the captive program is in line with Labuan FSA definition of captive. Any business owner as long as the structure, yeah. And so that's the case 3, that's Parkland. As I mentioned in previous slides, there's been heightened interest in captive since 2018. Hence, Brighton Group established Parkland on 25th of February 2020 and licensed as a captive insurer with a takaful widow. Each cell under Parkland can do general insurance, life insurance, takaful, or family takaful. Bear in mind, a cell cannot do all 4. They can only do one business each. Yeah, so there's no combination. So if it's a general insurance, then they can only do general insurance. If you want to do both life and general, you need 2 cells. Parkland is 100% owned subsidiary of Brighton International Group Limited and is managed by Brighton Management Limited. Brighton Management is a leading insurance manager in Labuan. We manage 93 insurance and insurance-related companies, including 23 captive as at 30th June. For the captive, we have 4 protected cells as well, including Parkland. And I'm pleased to say, hopefully, we will know the result on the 3rd of August, or 6th of August, 3rd of August. Brighton has been shortlisted as Captive Manager of the Year for Asia Captive Review Award in 2021. Benefit of cell in Parkland PCC Limited. Who usually use cell? Mostly smaller business owner, because to set up a pure captive will require capital and time and management and extra. So mostly, and also sometimes the business owner have lack of knowledge on captive and insurance is not their core business. Plus as well, the unavailability of cover and businesses owner requiring to have captive immediately to insure their risk fast. Yeah, so basically, who are they? Mostly is the first entry into captive. Secondly, why are they using cell? It's fast and easy entry. In Labuan, you don't have to apply for license, for approval from Labuan FSA. You just have to discuss with the core, and the core has to ensure that the program is in accordance with Labuan FSA definition of captive. And after that, we'll sign all the relevant documents and the cell, and capitalize the cell, and the cell is created. So I can say this can be done within a week to 10 days. Cell also is very low cost. Cell doesn't need board of directors, staff, office. Cell also do not need to comply with economic substance, which is very important because economic substance required in Labuan for captive is 2 staff, 2 full-time employees, 1 management level, and 1 can be any others, and 100,000 ringgit per year expenses in Labuan, not the company, but it in Labuan, which include maybe the license fees, etc., etc. Why do you choose Parkland? Parkland, although recently established in 2020, is managed by Brighton Management Limited, a leading captive manager in Labuan IBFC. So cell owner can establish their cell and leave the running and management of their cell to Parkland via Brighton Management Limited. Requirement in Labuan IBFC. I'm just comparing between pure captive and cell captive here. So minimum paid capital for pure captive is 300,000. The annual fees is $3,000. For cell, no prescribed minimum paid capital. Annual fees is the same to Labuan FSA, $3,000. However, the solvency margin for both pure captive and cell captive is the same. For general insurance, be it Islamic or conventional, must maintain at all times the surplus of assets over liabilities more than the amount of the working fund, which is pure captive 300,000, cell captive 500,000. However, when I'm talking about this, the cell captive, the PCC, the core will have to maintain that minimum of 500,000. Yeah, so for the cell, it's basically on the net premium. So it's either that or the higher of, yeah, okay, 10% of net premium income or 10% of the provision of outstanding claim for the preceding year, in respect of general insurance or takaful, 2.5% of cell actuarial valuations of the liabilities for the life insurance and family takaful business as at the last valuation date. What you have to do, you have to submit to Labuan FSA a business plan, normally 3 years business plan. What is the objective, the type of insurance? Don't get me wrong, cell will have to do almost exactly the same because we need to notify Labuan FSA and we need to submit this, notify all this to Labuan FSA once the cell is created. But you don't have to wait for a long time. You don't have to open a bank account because a cell bank account will be within the core bank account. In Parkland, we have HSBC, and each cell will have a designated accounts, separate account within Parkland, and the bank account will be managed by the cell owner if they want to. For pure captive, we need to submit the application form to Labuan FSA, and Labuan FSA client charter is 30 working days. So we have to wait for 30 working days, which is 1.5 months before we get the approval in principle from Labuan FSA. And then to open a bank account, will take another 2 months for pure captive, unless you have a very good relationship with a bank in Labuan. You may be able to open sooner than 3 months. So for pure captive, to establish a pure captive, it may take you around 3 months. For sale, 10 days. So that's the difference between the two. The corporate tax in Labuan is the same for both pure captive and sale. It's either 3% of the profit as disclosed in the financial statement of the year. But for the 3%, the pure captive must establish an office, meaning they must comply with the ESR, economic substance requirement, establish an office, minimum 2 full-time staff, minimum operational expenditure in Labuan. I must stress, it's in Labuan of 100,000 ringgit. Or if they don't meet the ESR, 24% of the declared profit. All companies in Labuan may opt to be taxed under the Income Tax Act as well. So, but once you opt to be taxed under the Income Tax Act, you cannot go back to Labacha, Labuan Business Activity Tax Act. But for the sale, if the core has complied with the economic substance requirement, so the sale will enjoy the 3% and the sale does not need to comply with the economic substance requirement. So these are the costing, pure captive versus sale captive cost comparison. As you can see here, this is just a best estimate here for pure captive. This does not include for pure captive does not include the BOD meeting, the traveling to Labuan, all the different compliance costs to be incurred by pure captive. For sale, everything will be done by the core. So the cost is roughly about 22,000. And for pure captive is 32,000. And annually thereafter, these are the costs. Like I say, pure captive doesn't look much difference, but it does not include all the board meetings, the traveling to Labuan, and the compliance function costs. The next slide was just the estimate cost for substance requirement in Labuan. So you can see here about $40,000 per year for pure captive. Thank you very much.
We have a couple of questions that came in, and at this point, I'd like to introduce our panelists as well. So we have Firas Al-Azim, Encik Abdul Halim Jantan, and Oliver Schofield, and they represent really a very wide array of players that is probably needed in order to develop a self-insurance vehicle. So thank you very much for joining us today, panelists. Thank you for taking your time. And thank you. Firas is joining us from Istanbul and Oli from the UK. So thank you for taking the time. And Encik Halim, you are in KL together with Annie and myself, yeah?
Yeah.
So the beauty of Zoom meetings and the beauty of Zoom calls, I guess, you know, we have to look for joy where joy is there. So there you go. In this day and age, it's true though. But thank you so much for joining us. Annie, very quickly, because there are 2 questions before we go into the questions that we discussed prior to this. And please, everyone who's watching, please post your questions directly into the chat box, and someone will be forwarding it to me. So the first question is actually from Nico Mangabat, and it's actually a very interesting question, right? Why do you have a reinsurer when a PCC is a self-insurance solution? Annie?
Yes, I think Oli is the person to answer this question. Anyway,
jump right in, guys.
And Halim.
Just jump right in, no problem.
Yes, it's basically, you know, as an insurance company, no matter whether you are small or big, you may need to spread your risk. You may need to have some coverage just in case there's a huge claim coming in. Oli, yes?
Yes, that's right. I think the one of my most favorite quotes about the use of reinsurance is that reinsurance companies keep insurance companies out of the mortuary chapel. So in other words, the reinsurance provides a catastrophic protection to the captive in the event that there is an unexpected, unprecedented deterioration in the severity and frequency of losses to that captive vehicle. The reinsurance allows it then to cap its overall exposure in any one particular financial period.
Well, actually, thank you for that, but it segues nicely to a question that actually Ming Wong is asking. In the event there is this massive claim, how are claims administration, how do you conduct claims administration within a PCC? Is it done by Park Lane, or is it the onus on the self-insured? And how is this monitored from a fraud and best practice point of view?
Okay, who's answering that?
Well, I'll happily give it a first go. So the way that claims are handled within the cell or in a full captive should be no different from the way that claims are handled by the broker and the traditional insurance and reinsurance marketplace. There will be a policy of insurance issued from the cell stroke full captive to its parent, and that policy will contain conditions and coverages and exclusions, and the claims need to be administered and settled under the terms and conditions of the policy that has been issued. In some cases, we see captives have a TPA. That's when there is a high volume of small claims going into the captive. In other cases where there might only be the expectation of one claim every 3 or 4 years, then a TPA job is not necessary in that case. And the captive manager, who employs underwriters and within their business, helps to determine with the cell itself the viability of that claim, and then processes it as it would with any other claim from an insurance market.
And for the uninitiated like myself, a TPA is a...
Sorry, third-party administrator.
Okay, thank you.
May I add something here?
Please, Firas. Yes, of course.
Okay, I mean, if you're talking about captives, it's anyway from one pocket to the other, because the owner, he will pay his claim to himself, right? But normally, I think there is also reinsurance or retrocession involved. So reinsurers, normally they have claims control clauses which enable them to get involved in the claims handling as well. So if the claims are big enough where the reinsurer has an interest, then they might want to be part of the claims handling.
Absolutely right.
Yeah, absolutely, yes.
If it's large enough.
If I jump in a little bit more, taking it a bit more to the front end, because I think what Ollie did and what Firas did was taking from the reinsurer and behind. Mr. Wong,
Yes.
your question then would be answered by your front-end broker. So if you've got a front-end broker, then the question of legality, the question of fraud, and the question of managing corporate governance is all handled in the front end by the front-end broker, which means you then report to the insurer, and the authorities are already brought into this. So assuming that it's a big claim, because you're using captive anyway, assuming that it's a big claim, there'll be the presence of your general counsel or your legal counsel. There'll be the presence of the insurers watching brief lawyers. There will also be the presence of the reinsurers watching brief lawyers attending to the claim. So in which you are insulated from all potential fraudulent act in that sense. And the broker then will carry out the function of handling your claims, i.e. in terms of documentation, negotiation, as well as creating the engagement within the various parties. And I think what's interesting, as Firas mentioned, there will also be reinsurers and everybody at the back end. So you want to make sure that documents, the information flow very, very seamlessly. Yes. So that at the end of the day, when the claims are paid, everybody is made aware. Otherwise, then you'll be in jeopardy of perhaps late payment and claims and the difficulties of getting into a fraudulent act in that sense. So all this will be tackled by your front-end broker with the engagement of all the relevant parties within this. So if you look at the captive, or if you look at the banking arrangement, the captive is really just like a cartel behind you that provides capacity. And these are the players that's arranged for you. And of course, Brighton and Park Lane then will be the one who will be looking at managing your claims at the captive or at the cell level, either negotiated at the core or negotiated at the cell level. So all these parties will engage to make sure that your life becomes less miserable.
And I think it's also crucial that the captive recognizes that it must only pay valid claims. If it starts just passing money back to its parent for a claim that is really not covered by the policy, then that income received back by the parent company is likely, under standard accounting regulations, is likely to be considered as taxable income. Whereas if it's a claim, it is non-taxable income.
Yes.
That's a very important point.
Yes, very important.
Yes, very important point.
That's the reason why I have all these people working in Parkland.
But that's really the thing, right? That's the thing about insurance and risk management that really completely I love, is the fact that it's a partnership.
Yes.
You know, you're unable to do anything on your own.
No.
Right? It's a very clear partnership, and you know, the bankers will hate me for saying this because you know the bankers say that their word is their trust, but there's a lot more trust in insurance and risk management than banking. That's my personal opinion anyway, but there you go.
And it's
thank you. We have other questions coming in, streaming in. Can we go through these questions? Yeah, I think it's a little bit more. Yeah. Okay, so there's another question which I'd like to take up from Jess. Actually, I'm taking it sequentially, so it could be a bit arbitrary, but as they're coming in, yeah, first come, first serve. Once a broker, always a broker. Mere notification to FSA on creation of cell, question mark. So I think maybe, Annie, this is a great opportunity to share with the market that Labuan FSA will soon be making an announcement pertinent to this.
Yes, basically, it was announced during the bilateral meeting between Labuan FSA and the Labuan International Insurance Association 3 weeks ago. This is very fresh from the oven, that cell creation no longer require Labuan FSA approval. So we only need to notify Labuan FSA within 14 days after the cell is created. However, what we need to submit, what we need to notify at the moment, we do not know yet. But we think it's exactly what we submit to Labuan FSA in the application form. So basically, whatever we did before, this, you don't need to apply for approval. It's basically the business plan, the captive structure, the programs, you know, who's the reinsurer, who's the fronting companies and things like that has to be provided to Labuan FSA in the notification. That's what we think. Yeah.
I mean, it will be logical, and it will be according to practice globally that that's done, because there is a layer of protection between the regulator and the cell owner anyway, which is yourself. So 14 days. But you know, I'd like to clarify a couple of things here. I'd like to ask you a couple of things, because the feedback that I've received from the market has been fantastic notification, so we can have a cell within a day. I think it's a little bit more complicated than that. Yeah, can you walk us through this, please, to manage expectations a little bit?
Okay, I mean, basically, you know, first you need to discuss with the co-owner. Like, we need to be comfortable that the risk, that whatever that you're doing, the program is within the definition of captive definition in Labuan FSA. Okay, I mean by the Labuan the Act. Anyway, and there's a lot of documentation to be done. For example, you know, there's an agreement between the sole owner and the core, and you know, we need to create a bank account for you to remit the fund into the bank account, your own bank account, to capitalize the sale. These sort of things. So that's why I said 10 days. To do this. But I mean, that does not include the discussion prior to that, you know, on whether this program is okay or not okay and things like that. Yeah. So that we'll need to discuss and need to see whether the program is within Labuan FSA.
Correct, exactly. And you know, as the owner of the core, then obviously internally within Park Lane, you have to make that value decision whether to take on the
Yes.
cell owner as well as the client. I mean,
Yes.
it's all about risk, and risk
Yes.
within Park Lane, aside from risk within the cell being carried, right?
Yes.
So
And
yeah,
I
so
mean,
that,
you must remember that Parkland still have to do all the due diligence. We have to make sure that all the
Correct.
names that is going to be listed, the company that is going to own the company, the cell, it's not listed in the sanction list. It's not, all the due diligence need to be done. That take a while to do. Yes.
yeah, absolutely, absolutely. So yeah, so there's another question from Vasana. About the main reasons to consider the use of cell is so that the cell owners can create innovative products, have an autonomy on the program, and to manage their group risk more efficiently. Reinsurers may be willing to write this risk and provide capacity, but what if there's no fronter willing to issue this for this risk, or they may need to do a regulatory filing which reduces speed to market? What do we do? Will the PCC be able to issue the policy? Specifically with the backing of a reinsurer, so like a back-to-back kind of issuance, I'm assuming.
No. Helen?
Yeah, can I?
Yeah.
Please, anyone, it's open.
The reality for this is, because it's a local admitted policy, I believe, Savannah, you are a Malaysian risk. So a Malaysian risk is what we call the admitted policy law. So if it is going to be a property risk, so you need a local fronting company. But today there are local fronting companies who's interested to do this. But the two things which avoid insurance companies in getting into captive option really is, if the risk is very big, then they have got to put serious reserving, which takes upon their corporate capital. That's why they're a bit reluctant to it. But like you said, if you have already got a structured reinsurance program behind it, where the insurance corporate capital, as Oli mentioned earlier, is protected by these reinsurance layers, then it makes it easier for the local company to be able to be the fronting company. Annie will not be able to get her core or her PCC to issue policy without a local front. And then it also depends on two things. If you're a Malaysian risk, there is every possibility that you could possibly go into an Islamic financing. Then you need the front paper to be a takaful operator. So which means you need a local takaful operator to front it. However, if you don't use Islamic financing, you've got conventional financing, then you can go into the general insurance companies. But you still need a local fronting company. So to get to market early, to get it quickly done, you need a front-end broker. Not that I'm selling a broking services, but you need a broker to look at structuring your reinsurances at the back to make sure that the corporate capital is managed. And more importantly, Annie will have to look at two things. One is your risk management regime. With your risk management regime, then your risk becomes mitigated in many ways. That will lead you into getting capacity. That will also lead you into getting better terms and conditions. Because don't forget, as it passes through the core and then the PCC and then into the reinsurers, it comes back to you. So you want to make sure that the risk that you are actually exporting, a risk that you can manage yourself, which is within your deductibles. And therefore, your balance sheet is managed. And for this, you need a few people in the scheme of things. You will need the likes of a broker. You will need the likes of Brighton and Annie. You will need the likes of Oli and Firas at the back end to be able to turn this around. Hence, the game into getting all this is just not getting to have a PCC very quickly, but is to be able to manage your portfolio first. So as Annie was about to say just now, which she didn't want to, but at that point in time, I think it's also important for you to get into this game, i.e. just not to get an approval. Remember when Oli talked about the taxes just now, the real reason why sometimes captive is used is just to pass money back as an income to the principal. That's not the game. Okay?
No.
It comes back as claims, you don't pay taxes. But for example, you've got an incestuous relationship. You've got a mother company who's also got lots of subsidiaries, and you've got a claim, and your subsidiaries can fix all this. Your O&M contractors, your EPCC, your machine suppliers are all within yourself. You can cycle back the money into your holding company. And as it comes in as a claim, you don't pay taxes. So it's tax avoidance. That is not allowed. Hence, the risk management regime, the real use of the core as well as the PCC is to make sure you've got very good risk management regime to make available to you capacity and perhaps competitive premiums. That's how we usually manage all this. So what you need to be speaking to is the right people at this point in time to make sure that your risk to market is quick enough. And then as any PCC can turn around in 10 or 14 days, you've got a PCC, but you've got your program manicured right from the beginning. It has got to be manuscripted. It cannot just be like on the ball.
So it's almost as if you...
Something?
Yes, please.
Sorry, just to make it a bit more international and pointing here at the protected sale concept. Now, in Europe, for example, you have Malta offering protected sale regime. There you can do direct insurance business. I mean, you don't need to have a fronter there because you're going to the protected sale in Malta, and Malta has a European pass, so you can become an insurance company at a very cheap price because you're renting the cell in the protected cell core company, and then you can offer direct insurance directly without having a fronter. But I think because Labuan is an offshore, so you cannot do Malaysian business, or you have Bank Negara who needs to come up with a solution for that. But until now, situation is you are doing protected cell as a reinsurer, so you need a fronter there.
I think the situation in Europe with regards to fronters and admissibility is quite different from what we enjoy, as it were, in Asia. What's interesting? There's an international question here for you, direct for you, Oli, from Chatya Chandra. So I think this person is referencing Gujarat International Center, who recently passed regulations allowing for captives. What are your thoughts about how this will impact the captive industry in APEC?
I think the creation of the captive legislation within the Gujarat International Financial Tech City is a huge shift, a positive shift in the way that the Indian insurance regulator and government is looking at how captives can help organizations enhance their risk management, etc., etc. The legislation that exists within GIFT now enables Indian companies to establish captives in Gujarat, whereby all of the domestic Indian exposures can be placed into that captive in Gujarat. But note, it only applies to the Indian domestic exposures. So if you are a global Indian multinational, you now have the ability to put your domestic exposures into a captive. As a global Indian company, you also still can establish captives in places like Mauritius or Labuan, or anywhere else in the world, so long as that is established via a non-Indian financial business. So in other words, through one of their offshore subsidiaries in Singapore or elsewhere. We are currently working with 3 large Indian multinationals to explore the establishment of a captive in Gujarat, as well as then a captive for their non-Indian locations elsewhere in the world. And we basically think it is a really exciting and very important development in the world of captives and risk management for India.
Yeah, no, I completely agree. And in a way, India, with all due respect, it's a bit late in the game because this is what China's been doing over the last 6 years or more. That lots of different centers within China that caters specifically to Chinese risk. And actually, it's interesting because, on surface, when you look at it as a jurisdiction, you think, oh, this is competition, but it's not competition because what happens is a lot of multinationals within that country start looking at self-insurance vehicles, understanding it better. And then, as Oli says, they start exploring all the non-domiciled risks or offshore risks, as it were, and start looking at different jurisdictions where they can start managing that risk more effectively. So the more the merrier, I say. So yeah, we absolutely welcome Gift City issuing captives. There's also an interesting question. We've completely run out of time, panel, but there's still a lot of people tuning in and there are more questions coming in. But there's an important question I wanted to highlight. And the question is, once you have a cell, how easy is it to convert it into a pure captive? Annie?
Yeah, I mean, it's actually for now, as far as we know, it should be quite easy. We just have to submit another application to La Bonne FSA based on whatever name that you want, and then incorporate the company, transfer the whole bulk of risk or assets and liability from that cell to the new captive, and that's it. Of course, that you will need to have a letter of guarantee saying that there's certain risk that may be left in the cell that was not transferred, things like that that should be transferred in the future for the next 5 years. You never know, depending on what type of risk that is.
Okay.
So,
Put a caution, Farah. Is it okay if
Please,
I offer
of course.
a opinion?
Please.
Ideally, ladies and gentlemen, for all those that's listening, Farah's question is fantastic. That's heading into the future. Because really, you want to start with a PCC, but ultimately, you want to be the core cell yourself. I.e., if you are going to get into an insurance game, ultimately, you want control. Hence, you get into core. But in trying to get there, as Annie mentioned, you make sure you commutate, you've got your proper reinsurance program, you commute, and some of the policies that you have, which are long tail, have got to be managed and properly reinsured to make sure that you don't leave any retentions. Therefore, your reserving is going to go sky high. So ultimately, you move pseudo insurance company by having your core. That's when it opens up for you with all this fintech play and digital banking in the future to write not only your risk, but other risk within the similar industry. So for you, getting into sell is just not looking for capacity, not looking for cheap and available premiums, but is it an income that you want to actually think about in the future by getting into the pseudo financial market? I think ideally, when people get into captive, you have to be interested in the business. It's got to be a long-term plan. So ideally, that's where you want to go. Just don't stick yourself with a PCC. You want to get serious, you want to be in the game. That's how it should be.
It's a first entry. A cell is a first entry.
Yeah, I mean, what we say sometimes when we talk to potential owners or sales or captives is like it's training wheels, right?
Yes.
And then when you grow up, you want to be a pure captive, as it were. But I wanted to bring Firas into the conversation a little bit because I'm very curious about the possibility of the growth of self-insurance. So we've talked about growth self-insurance in China. That's been going on and continues to go on. They understand it very well. India is obviously getting into the game. The MENA region, so Middle East especially. And what are your thoughts about the potential? And obviously there are other jurisdictions within the Middle East that currently already do offer captive solutions. However, the uptake has been very, very limited, if at all. Do you think there is going to be a possibility for more MENA-based entities to understand self-insurance and actually take it on?
I mean, what you said, the MENA region and particularly the GCC countries, if you want to say this is where the money is, they were not so much involved into captive business, except if you take Aramco, of course, they have their own captive in Bermuda, and this is quite big, and this is the third largest company in the world and so on. So you can imagine the volume they have placed there. But in the GCC itself, the captive business is very little. You have DIFCA in Dubai. You have the one in Abu Dhabi. So overall, there are maybe 12 captive businesses there at the moment, if you include Bahrain, Dubai, and Abu Dhabi and Qatar. So, but what is happening now that there is a trend that people are now getting interested into captive business because the market is hardening, because the regulation is getting there. Our risk-based capital regime is introduced, the regulators are getting stronger, and so on. And plus, I mean, the problem in the past was always that the MENA region is not heavily nat cat exposed. So prices were always cheap, but now with the hardening, it's getting more difficult to place business.
Yes.
So the interest is there, and the interest is not only for oil industry, petrochemicals, and so on. There are requests from other sources. So I can believe that there will be increase and demand for captive business and for PCC. And because, say, Labuan, and what you mentioned already, that you have the takaful possibilities there and the Islamic captives in Labuan, I believe there can also be a role for Labuan to get into this business.
And is there, we're seeing a bit of solvency arbitrage. I mean, Oliver will talk us through the solvency arbitrage potentially with Europe and certain other entities, jurisdictions vis-a-vis Labuan, right? But what is the solvency requirement for the region, Firas?
I mean, like what is everywhere for captive business, solvency or minimum capital is much less than for normal insurance companies. You will say it's $100,000, for example. That's a minimum capital you have to pay in Bahrain and against 27 million. So you see there's a big difference between that.
Yeah.
So, but solvency is getting more like the insurance companies, but you have for captive special and less, and it's easier.
Actually, Dubai
and
just
reporting
introduced that.
And reporting requirements. Instead of having quarterly reporting, you have only a yearly reporting requirement. So they're trying to ease this thing. So the competition between the places offering that is how easy you are and how easy it's to open and how easy it's to exit also.
Yes,
that's
very
true.
important. Exit's
important. We have a question from Suryati Asma Abdullah, which is quite interesting. So I'm going to paraphrase it, but can a company have a combination of pure captive and PCC depending on the different classes of risk? I mean, from my understanding is that when you have a pure, you tend to lump it all together. I mean, a holistic risk profile. And then when you have a cell, it tends to be quite specific with regards to the lines of coverage. Annie, do you want to talk us through, or any of the other panelists?
Yeah, I mean, Oli, okay.
Thank you, Annie. The answer is yes, you can. And one of the examples of that would be, for an organization that is involved in selling consumer goods. They might have their pure captive to cover their own employer's liability, their own assets, their own motor fleet, and so on. But they might offer consumer insurances, such as warranty insurances on those white goods. And they wouldn't necessarily want the exposure from one or the other to be mixed in with the other. So they could have the pure captive for all of their own corporate exposures, and then the cell captive for all of their consumer-driven insurances, their third-party insurances. And that to me would be a logical approach. Another approach would be where a global organization has a captive again for all of its own risks, but perhaps in the European region, it wants to be able to issue direct policies across Europe. But they've already got a captive in Bermuda that can't issue direct policies into the EU. So they might set up a cell captive in, for example, Malta, to be able to then issue those policies on a freedom of services basis across the European Union.
I have also seen where beyond pure captive, cells are being used for where you have got multiple jurisdictions or multiple locations, and the law interferes with your instructions. So you use a cell then to get away from that differentiation in the laws that perhaps differs from each and every jurisdiction or geographical area.
Yeah, there's also that legality of a cell vis-a-vis a corporate structure that's being set up, and you know, pursuant to your statement. And you know, I think the beauty of cells is that, number one, they're so easy. I mean, I like to call it the democratization of self-insurance, the commoditization of it, because it's like AirAsia, everyone can have one now. In a way. But, you know, what's important to remember is that flexibility also allows you to be very specific as a cell owner with regards to the kind of risk that you can put into one of these cells, because it doesn't mean you have, you know, I think the mindset about having a cell is very different from having a pure captive. When you have a pure captive, you've invested lock, stock, and barrel into it. You're going to put your holistic risk into it. When you have a cell, on the other hand, what's going to happen is that you can be very bespoke in what you put, the kind of risk you put into that particular cell, and have quite a few of them. because obviously they're not as expensive and not as painful. But having said that, there is a question from Iskandar Eden here. What a beautiful name. To say, to set up captive management would typically want to know the business case of having a captive. What do we need to do to go about that? So, you know, are the business cases, the business plan, I guess, that needs to be sent to the core, would it be as expensive, I'm assuming, Iskandar, is your question, as a box standard pure captive, as it were? Would it be as intense as that? Anyone?
Yeah, okay, Alan.
If you don't mind me starting you, then you can continue. When we did this like 2 years, two and a half years ago, there were two reasons for it. Reason number one is you want to make sure, Iskandar, two things must happen. That your business plan will go through the test of time for you then to graduate, for example, into whatever you want to be. That's one. Together with that, you need a pure and a very strict regime, risk management regime. Because now you are your own self-insurer, you're writing your own risk. You want to make sure that your claim is going to be those that's within your risk appetite and your net retentions. Now, the other point which is also important is, as you graduate into this, you'd want to be very clear in your minds that your business plan is just like any other solid business plan. Why? This business plan is going to be used not only for the purpose of your registration, your approvals, but it is also to make sure that your back-end team, so if, let me take, say, for example, utility company. Utility company here, you can have a failure and a butterfly flap, which is just 5 ringgit, but because of that failure of your butterfly flap, you lose 60 days of capacity payment with your off-taker, and assuming your capacity payment is 2 million a day, that's 60 million lost. So you want to make sure your business plan incorporates all this, because at the end of the day, as you become your self-insurer, you want to make sure these are managed properly. So if I go back to the basic business plan, your business plan then together with your front-end broker, you got to be very clear in your mind that it has got to be done solidly and well, whether it is for pure or for a sale.
Yeah.
Then Annie's job becomes simpler. Then Annie can direct you into the areas where, oh, okay, now we have a look at your portfolio with your proper business plan. Annie can also say, okay, let's separate the employee benefit into a different cell. Because if the employee benefit goes bad, you don't want your core to be in trouble. So you separate it out. So there's a lot of differentiation that can be done with a solid business plan. Just like a marriage proposal. You want to be very clear with what you want so that all the experts around you, the Ollies of the world, the Firas of the world, the Annies of the world can give you real smart ideas on how you slice and dice it to take advantage of the market, the capability, and also the capacity that's available.
Yes.
Hence the solid business plan. Start it with your front-end insurance broker. He cooks it with you to make sure that all along the way, you benefit from it. That's my view.
May I add also something here? I think because if you do a pure core, you have to convince the regulator. If you do a cell, you have also to convince the core because it has to fit the core, right? So you have two instances here who will check it before giving it to the final regulator.
Plus,
so
you have to convince your board of directors. Right? Yes.
Yeah,
You have to convince your board of directors that you are
Very
setting up something. Yes, because no matter what, whether it's a cell or a pure captive, there's still risk there. So you need to convince your board of directors. I mean, without a solid business plan, you will not be able to convince your board of directors.
Maybe one thing between the cells and the captive, it's the rating of the captive or the rating of the cell. Because at the end, the fronting will be affected by the rate of the cell or the captive insurance. So I can imagine that certain cells, and correct me, they have a rating. So this can have a positive effect on the fronter. Otherwise, they need to make additional premiums and reserves and so on. So Oliver, maybe you can add something to that?
Yes, we certainly have seen more interest from captives and from sales to have a rating. The challenge that the rating agencies have nowadays is that if it's a startup captive or a startup cell, they really struggle to be able to determine whether or not that vehicle, standing on its own 2 feet rather than having to rely on its parent, whether that vehicle has the sufficient financial strength and history to be able to justify being given a rating. Firaz is absolutely right when he talks about the benefit of the rating in terms of the way that a fronting insurer would look at the capitalization or the securitization that would be required to give comfort to the front. And I suppose one of the surprises to me over the years of being involved in captives is that more captives have not gone down the rating route, more advanced captives, the ones that have been around for 5, 10, 15 years. And I guess the reason why is because they as captives have got a good long-term relationship with the fronter and have been able to say to the front, well, we have the trust account, we have the letters of credit, we have the appropriate collateralization, parental guarantees, and by the way, our parent is AA- rated, and you're only A rated. So, stop talking to me about security in our organization. So there are those issues as well. But rating, I think, is of huge benefit to captives and to sales.
Actually, just to add, there's a question from Isidine here that actually segues very nicely. It's like we knew what he was going to ask, and in the sense that he says, how important is it for the core to be rated? And what would be the limitations of the cells to encounter if the core is not rated? So I think before you guys answer this question, what I'd like to highlight is a couple of things. Number one, within that captive space, you have pure captives, but you can also have a pure core, i.e. a pure PCC. So, not all cells are rented from a Park Lane. You could set up your own PCC, and it's important to remember that, right? So you have your own protected cell company where you run the core, but the benefit of having the bankruptcy remoteness of each line, as Halim was talking about, comes to the fore, because you're then really double lining your risk, as it were, within your organization even. And I really want to highlight that, because I think a lot of our conversation has been fantastic panel, because we haven't gone through any of our prepared questions at all, which is perfect. I really like to highlight that you can have your own PCC in order to double line your risk in each cell. It doesn't have to be via a rented core, as it were.
That's why I mentioned during my presentation, a PCC, you can use it as, if you have multiple line, multiple business, multiple segment, multiple location, you can set up your own PCC. And you still can come to Brighton, and Brighton can manage it, because Brighton is managing many other PCC as well, including Park Lane. Although Park Lane is owned by Brighton.
Oh, Brighton. Okay, so very incestuous, but good. So non-rated. So I guess that kind of answers Isidine's question. We are 15 minutes over time. There is one last question from Sharifah, which actually quite brings us back to the core of this. Pun intended. How does a core strike a balance between its risk management regime and its risk management appetites? But she does not, right? She does not, Sharifah Munaim, does not qualify whether it's a core, i.e. a commercial core, or an owned core. A self-core, as it were, a pure core. So I think this is probably going to be our last question. Anyone wants to take a dig at this, please?
Can I take it? Oli, please, Oli, sorry.
Halim, after you, my friend, and then I'll follow up.
And I follow up.
Assuming that it's a core, then you have got to make sure your risk appetite and your calculation for risk appetite following your EBITDA must be real first, because that's your immediate deductible level. Anything lower than that is going to hit you right smack into your front pocket, not your back pocket. So having said that, if it is a PCC, regardless of both situations, you would want to analyze your risk appetite first, even before you consider a captive option. That's how it should be. And the next stages and all that, Oli will take you through.
Yes, I think one of the things we find very useful, a useful tool for anybody thinking about establishing some form of formalized self-insurance vehicle, is to undergo or to go through a feasibility process.
Yeah.
Now, there are many different ways of achieving that, but one of the key benefits of going through that process is that the board of the parent company, the owner of ultimately of the cell or the core, the captive, whatever, the board is engaged in that process, because you cannot afford to have a situation where you have a risk manager whose department think that their risk is the best risk in the world. And let's face it, every risk manager should think that their risk is the best risk in the world. And they think, well, you know what, we can afford to take a self-insured retention of $500,000. That's within our appetite in the risk management team. We're comfortable with that. And then we go all the way through the process, get to the end, present to the board and say, great, we're going to take $500,000. And the finance director says, no, we're not. And then that's where the disconnect arrives. So to avoid that disconnect between the risk management regime and the risk management appetite, i.e. the finance team, you get the board involved from day one in the conversations. And those conversations then evolve over a period of time. The feasibility process is undertaken, and the results of that are very much within the appetite of the finance function as well as the risk function.
Yes. So it's about getting together mentally at a particular risk appetite level before even venturing into anything, and exploring the structures. Fantastic.
I think what Sharifah is trying to ask is, how do you, for a cell and the core, balance it? So basically, the core, the risk of the core is making sure that the cell pay up to the owner of the cell. So the cell, the owner of the cell, or whoever is the risk manager, making sure that the risk that's put into that cell has sufficient financial to pay the obligation back to the owner. So it's not the core as the core. I mean, if it is like a commercial PCC that is responsible, so of course they are responsible making sure that all these risks are in place, but at the same time, the owner, because you must remember, the owner insure themselves. This is like a formalized self-insurance. And if anything happen, if they don't have enough money, and a PCC is like, it's ring-fenced legally, so the money is only from that cell to pay back to the owner. Okay.
So that said that, let's not lose sight of this, and he's absolutely right. But I always like to go back to the point where Ollie made. So there will be structures within the reinsurance program, Sharifah, that you can take advantage of. But you got to start with that feasibility study, engaging everyone, especially your finance director, to make sure that your appetite is where you start from. After that, you can have reinsurance program, reinsurance structures within your core as well as your cell to manage the risk as you go along.
Yes,
absolutely, Halim. It's about the net risk appetite, and obviously that net risk appetite, the gross can be much higher, which is then protected and brought down through the use of the reinsurance program.
So
maybe
I
also
guess,
to add,
please.
last one, protected cell is a protected cell, so it's a cell which is the one paying the claims. It's not the core; it's a cell.
Not.
And in the cell, you have solvency capital, you have to make sure your reinsurance is correct and so on. So that's the job you have to do. But of course, you have a manager who will do it for you, but the cell is the one, and therefore protected. It's ring-fenced.
Yes,
like Anis just said,
But I guess I was going to say, like everything else in life, you start right, you finish right.
Yes.
And the start is always your risk appetite, what the risk is, your risk appetite, what you're willing to pay for it. And then, like I said earlier, it's about the partnership along the way. And thank you, everyone who's watching, and thank you, the panelists, for your partnership. It's been a fantastic discussion, completely ad hoc, completely just based on questions coming in from the audience, which we really appreciate. So I guess we'll save the questions for our next webinar. Thank you, everyone, for staying behind, and we've still got plenty of people who stayed back. We're overrun by about 20 minutes now.
Yes.
And the only thing aside from thanks is to wish Firas a happy birthday. Selamat
you very
Hari
much.
Jadi. Selamat Hari Jadi in Malay,
Thank you.
which is happy birthday.
Terima kasih.
Eight, something like that in Arabic. How do you say in Arabic?
Eid Milad Said.
Eid Milad. Okay, yes.
Eid Milad
It's a bit
Said.
long.
Eid-
Yeah.
Okay.
That's
Eid
right.
Milad Said. Voila.
Okay. Well.
Okay, thank you very, very much, everyone. So until we see you for the next one, thank you once again, Park Lane, for this partnership, and have a good evening, if it's evening for you, or the rest of the day for wherever you are. Thank you.
Thank you.
Thank you very much.
Assalamualaikum to my fellow Muslim friends.
Waalaikumsalam.
Waalaikumsalam.
Bye.